September 2008. A 158-year-old bank collapsed overnight. More than $600 billion vanished. Pension funds evaporated. Millions lost their jobs. But what if I told you? The real cause started with a lie. So simple, it could fit on a billboard. That lie didn't come from Wall Street. It came from Washington. For decades, America believed in a beautiful idea. Everyone should own a home, not as a dream, as a social duty. After World War II, homeownership became the backbone of the middle class. Stability, responsibility, less likely to rebel. By the 1990s, the U.S. government was no longer just encouraging it. They were pushing it. Banks were pressured to lend more, especially to people who had never qualified before. The language sounded humane. Affordable housing, home ownership for all. But the mechanism behind it was never emotional. In 1999, the Glass-Steagall Act was dismantled. Commercial banks and investment banks began to merge into one. From that moment, a mortgage was no longer a long-term promise. It became raw material, material to be packaged, sliced, sold. A 30-year mortgage from a car mechanic could be broken into hundreds of pieces and end up inside a pension fund in Europe. The borrowers stopped matching. Cash flow became the only thing that did. And to keep cash flowing, the system needed just one thing: more borrowers. They didn't need to be wealthy. They didn't need to be stable. They just needed to sign. That's when creative loans appeared. No income verification, no down payment, low teaser rates for the first 2 years. Perfectly reasonable, at least on paper. Billboards across America repeated the same line. Why rent when you can own? No one lied about the numbers. They simply ignored what came next. And at that moment, no one wanted to ask the most uncomfortable question of all. If a system only works, when more and more people keep borrowing, what happens? When there's no one left who can pay? By the early 2000s, homeownership was not just about a roof. It was a ticket to wealth. Adjustable rate mortgages, balloon payments, ninja loans. No income, no job, no assets. No problem. Banks did not care. They never intended to hold these loans. Every mortgage was a product. Every product generated fees up front. Loan officers collected commissions. The risk was not theirs. Their job was to create more loans. And that is when the system revealed its first trick: securitization. Thousands of individual mortgages, good, bad, and ugly, were bundled together. A label was slapped on top, sold to investors around the world. These bundles became mortgage-backed securities, or MBS for short. Now, the risk of a single borrower was no longer a problem. It was shared, or so it seemed. But Wall Street did not stop there. They took the riskiest slices of multiple MBS bundles and recombined them. A new product was born: collateralized debt obligations, or CDOs. Roughly, tâche équale supposédly gold. Investors looked at these CDOs. The rating agencies called them AAA. AAA, safe as government bonds. The kicker: the agencies were paid by the banks they rated. If they downgraded a CDO, banks could take their business elsewhere. Competition ensured inflated ratings. By 2007, nearly 45,000 mortgage-related securities had AAA ratings for Moody's alone. Most of them were built on shaky loans. The first cracks were invisible to the public. Even the people buying entrusted the numbers on paper. And that is how a bubble transforms into a global machine. Borrowers sign loans they cannot repay. Banks slice, bundle, and sell the risk. Investors buy them, thinking they are safe. The system rewards volume, not prudence. At this stage, risk is spread. But spreading does not destroy risk. It amplifies it. The twist: the very structure that promised safety, diversification, AAA ratings, global investment, was what allowed risk to grow unchecked. Everyone believed the system protected them. It did not. The first domino was set. The next question loomed: what happens when borrowers fail at scale? By 2005, buying a house was no longer about stability. It was about flipping it fast and making a profit. Real estate was a lottery ticket. Everyone wanted in. Teachers, baristas, construction workers, all buying multiple houses with zero down. Prices skyrocketed. Your neighbor's house doubled in 6 months. No one questioned it. Why would they? Banks made more loans. Mortgage brokers earned higher commissions. Volume mattered more than risk, and everyone kept borrowing. The first cracks were small at first. A missed payment here, a foreclosure there, condo in Las Vegas sitting empty. But the cracks were spreading, and the system was fragile. In 2007, Bear Stearns, the $75 billion hedge fund bank, collapsed. The government stepped in. They saved it. Fannie Mae and Freddie Mac, two pillars of the mortgage market, were taken into conservatorship. Taxpayers now on the hook for hundreds of billions. The market thought Lehman Brothers would be saved too. After Bear Stearns and Fannie and Freddie, people assumed the government would step in again. But Lehman was left to fail. By September 2008, Lehman Brothers, 158 years old, $639 billion in assets, filed for bankruptcy. The message was clear. No one was safe. Banks stopped lending to each other. Credit markets froze. Companies could not pay salaries. Families could not get mortgages. The first dominoes had fallen. The cracks were no longer small. The house of cards was wobbling in full view. Lehman was more than a bank. It was a signal. A system built on constant growth and borrowed money could stop in an instant. And everyone learned that financial institutions were connected in ways nobody fully understood. One failure could ripple across the globe. Markets from Tokyo to London to Sao Paulo reacted. Stocks fell. Banks teetered. The global economy paused. The illusion of safety, the AAA ratings, the supposedly diversified CDOs. All of it was irrelevant now. The stage was set for the largest collapse of the modern era. And yet the system had been functioning exactly as designed, rewarding growth and turnover, ignoring true risk. The question remained, what happens when all the small cracks join into one massive failure? By September 2008, the cracks had joined. The system was ready to collapse. Lehman Brothers filed for bankruptcy. $639 billion in assets gone overnight. The largest bankruptcy in U.S. history. No valor, no giro, just a hole in the middle of Wall Street. The message was clear. If Lehman could die, anyone could. Banks stopped lending to each other. Credit froze. The financial plumbing of the economy stopped. Companies could not borrow to pay salaries. Families could not get mortgages. Markets everywhere reacted. At the same time, another tool made the collapse worse. Credit default swaps, insurance contracts on mortgage-backed securities. Investors could bet against MBS without even owning them. Insurance companies like AIG wrote contracts worth tens of trillions of dollars. Many had no ability to pay if the bets failed. This was a parallel market, built entirely to profit from failure. Risk was no longer contained. It was amplified. The system had become a giant Jenga tower. Each block a mortgage, each layer a bundle. The top was bonuses and fees for Wall Street executives. Whistleblowers warned. Regulators ignored. No one stopped the machine. By late 2008, panic spread. Hedge funds lost billions. Investment banks took massive write-downs. Markets fell globally. Iceland's banks collapsed. Tokyo stocks plummeted. European leaders scrambled. From London to Sao Paulo, markets were in freefall. Main Street felt it immediately. 8 million jobs lost by the end of 2008. 4 million homes foreclosed. $19 trillion of household wealth evaporated. Ryteris watched 401 KS vanish. Families lost homes. Soup kitchens overflowed. Meanwhile, Wall Street still paid bonuses. People who created the collapse received golden parachutes. The system rewarded exactly what it was designed to reward. Not survival of Main Street. Not repayment. Not prudence. Lehman was not a mistake. It was the outcome of a system operating perfectly, rewarding turnover over stability, volume over caution, profit over sustainability. The tower was cracking, the dominoes falling, and the world was watching. The first layer of truth was clear. Financial systems do not collapse because of greed. They collapse because they incentivize what causes collapse. And Lehman was the ultimate proof. A perfectly designed disaster executed in slow motion. The government faced a choice: let all burn, or throw billions at the banks. In October 2008, they chose the latter. $700 billion for the Troubled Asset Relief Program. Taxpayer money handed to Wall Street. AIG, the insurance giant, received over $180 billion. GM and Chrysler car companies got $80 billion. Everyone who was too big to fail got a lifeline. Meanwhile, the Federal Reserve lowered interest rates to near zero and launched quantitative easing, printing money to buy bonds and mortgage securities. A patch for the system, not a solution for Main Street. Markets stabilized. Banks unclenched. The stock market bottomed in March 2009. Wall Street exhaled. But Main Street was still choking on smoke. Unemployment hit 10%. 8 million jobs gone. 4 million homes foreclosed. $19 trillion of household wealth vanished. Families that had never missed a payment owed more than their homes were worth. Food stamps and pink slips replaced stability. Wall Street paid bonuses again. Main Street queued for soup. In 2011, the movement began. Occupy Wall Street. Zuccotti Park, New York City. Thousands gathered. Tents, drums, cardboard signs. One read, "We are the 99%. The system rewarded exactly what it was designed to reward. Privatized profits. Socialized losses. Golden parachutes for those who caused the collapse. Nothing for those who lived through it. No major CEOs went to jail. No handcuffs. No public accountability. Just quiet retirements. The financial system survived, but trust was destroyed. The underlying mechanisms did not disappear. They changed shape. New instruments. New names. More complex rules. The question remains, if a system once created this disaster, what makes anyone believe it has stopped operating today?